The concept of microcredit is based on one simple idea: lending small amount of money, often less than a few hundred ringgits, to the poor, and they then repay through establishing small businesses, like grocery stores or tailoring shops, allowing them to escape poverty while at the same time boosting the local economy. No one necessitates the existence of microcredit, mainly because traditional commercial banks refuse to lend money to the poor. For obvious reasons, because most of the poor are unemployed, have no assets for collateral, or have bad credit history. These all contribute to repayment risk that the traditional commercial banks just aren't willing to take. Microcredit institutions, on the other hand, do not require any of the conditions above. It is based on investments in the potential of the poor, which they believe are underutilized. The concept of microcredit is developed by Mohammad Yunus, a Bangladeshi economist who had founded Grameen Bank, a community development institution back in 1976. They have since built an innovative business model that provided ideas that could help eradicate poverty for countries all around the world. In 2006, they are awarded Nobel Peace Prize for their efforts through microfinance to create economic and social development. Without the security of collateral or any legal contract, the bank employs a system called solidarity lending. Instead of lending to individuals, Grameen Bank lends only to a group of people. The members of the group support each other's economic advancements, while adhering to values that reinforces good social habits preached by Grameen Bank, called the 16 Decisions. The peer pressure within the group and trust among each other and the bank then ensure repayments. Although members are not liable for each other's debt, if one of the group members defaulted, the bank will refuse to lend to all of them. This creates a strong incentive to repay the loan. This scheme based on relationship has been working. Grameen boasts a repayment rate higher than 95% while turning profits in tens of millions of dollars. Grameen Bank has today over 7.5 million borrowers. 65% of them managed to clearly improve their socio-economic conditions and lifted themselves out of extreme poverty. Another unique feature of the bank is that 98% of the borrowers are women. The traditional commercial banks in Bangladesh are unwilling to lend to women due to cultural reasons. This has created a lack of demand for financial services targeted at women and the poor, and thus a niche area to be filled. Grameen Bank took the role and has empowered these women by funding their entrepreneurial spirit. The program has tremendous success and has created a new class of women who raise themselves from poverty in the country. The majority of the bank's board members are women who have benefited from the loans and have successfully escaped from poverty. At the moment, Grameen Bank borrowers own 94% of the bank. The remaining 6% are owned by the government. Following the success of Grameen Bank, several microfinance institutions in Malaysia have been formed. Among them are Amanah Ikhtiar Malaysia (AIM), Yayasan Usaha Maju (YUM), and the Economic Fund for National Entrepreneurs Group (TEKUN). Malaysian microfinance institutions have different types of lending systems and provide services to different strata of people. AIM and YUM offer loans to the poor and hardcore poor women, whereas TEKUN gives loan to both poor and not so poor men and women borrowers. AIM uses a group lending scheme, whereas TEKUN and YUM use an individual lending scheme. In stark contrast to Grameen Bank, microfinance institution in Malaysia has relatively little success in the early stages of development. This is especially true in the case of Amanah Ikhtiar Malaysia (AIM). When it comes to executing microfinance, Amanah Ikhtiar Malaysia (AIM) encountered three failures. First of all, misguided objective. AIM has had a convoluted development over the years, experiencing a mission breakdown from 1992 to 1999, when the original objective of AIM to assist the poor was distorted by political motives. This breakdown began in 1992 when the existing members in top management were replaced with new members who wanted AIM to be a mechanism to attract political supporters. Due to their fear of bad debts, the bank increased the requirement of borrowing and ended up boxing out the poor people, whom the institution professed to offer help in the first place. As a result, this caused AIM's system became not consistent with its original objective, as it introduced a few loan schemes that also provide the loan to not so poor people, or even rich people. Also, it provides larger loan amount instead of smaller loan amount as in Grameen Bank. Due to the sensitivities of its Muslim clients and sponsors, Amanah Ikhtiar Malaysia levied service charges on loans rather than interest expressed in percentage terms, which is lower than interest rate in Malaysian commercial banking sector. As a consequence, loan service charges covered only a portion of AIM's lending costs. AIM and YUM impose weekly loan payments on all types of businesses, both small and agricultural businesses regardless of their business revenue cycle. The Grameen Bank lending contracts are far more flexible than the Malaysian microfinance institutions. It offers loan repayment modes. Duration, amount, grace periods, and interest rates charged are tailored to the nature of the borrower's businesses and are based on the borrower's affordability. They do not impose similar loan contracts on all borrowers or business types as do Malaysian microfinance institutions. This shows that Malaysian microfinance institutions are essentially subsidized by the government. Microfinance institutions in Malaysia only offer microcredit loans and do not have incentive to offer any other microfinance products. The Grameen Bank, in contrast, apart from offering microcredit as a core product, also offers micro-savings, micro-insurance, and pension funds to its borrowers. All of these products will generate revenue for the microcredit institutes. And a recent development in the microfinance industry in Malaysia, Bank Negara Malaysia in 2007 gave a mandate to several banking institutions in the country to offer microcredit loans. 9 banks are involved. These are the microfinance products offered in Malaysia and their features. Comparing them to microfinance institutions' loan schemes, the loan sizes are similar. The minimum is 500 ringgit, and the most common maximum is 50,000 ringgit. The sectors involved are more or less the same, focusing on manufacturing, agriculture, and retailing where the poor can be targeted. The big difference between microfinance products offered by commercial banks and microfinance institutions are the eligibility of their clients. The commercial banks require the borrowers to be salary workers or self-employed. Hence, they fail to target the poorest of the poor. At the end of 2009, AIM has total borrowers of 200,000, with total loan disbursed of around 3 billion. In conclusion, the problem of microfinance development in Malaysia is mainly due to the misusing of funds allocated to the poor. To overcome this, political influence, which distorts the objective, has to be erased so that the truly poor can be targeted. In the end, the future comes down to whether these institutions can be independent from government's grants and subsidies.
It's been a long road getting from there to